So I will be explaining the introduction. In conventional banking, the stated interest rate does not always reflect the true cost of financing because it includes additional charges such as administrative fees, processing costs, and compounding effects. Therefore, the effective interest rate (EIR) is used to show the actual annual cost of return of a loan in a more accurate way. In Islamic finance, the effective profit rate (EPR) is used instead. Instead of interest, it is based on profit generated from Sharia-compliant contracts such as trade and leasing. This is because Islam prohibits riba, as stated in the Al-Quran, Surah Al-Baqarah, verse 277. A'udzubillahi minasyaitonirrajim. Wa ahallallahu al-bay'a wa harrama riba, which means Allah has permitted trade and forbidden riba. In conclusion, both EIR and EPR aim to present the true cost of financing, but EIR is interest-based while EPR is profit-based and aligned with Islamic principles.
Effective profit rate or EPR is the actual annual profit rate after taking into account the timing of cash flow and the effect of compounding. It shows the true cost of Islamic financing or the real return earned by the bank. Although it is similar to the effective interest rate in conventional finance, EPR is used in Islamic finance because it is based on Sharia-compliant profit transaction instead of interest. Next, the key concept behind EPR is that Islamic finance prohibits riba, or we call it interest, and instead use rate-based contracts such as murabaha. It also applies the time value of money principle, which means money received in the future is worth less than money received today. Therefore, future payment must be considered when determining the true profit rate. For example, in Murabaha contract, a bank buy a car for 10,000 and sell it for 12,000 with payment made over 10 years. Although the profit is 2,000 and stayed upfront, the installments are received over time. So the effective profit rate is used to calculate the actual annual profit rate based on the timing of this payment.
The effective interest rate is the actual rate that is earned or paid on a financial product after taking into account the effect of compounding over time. It gives a more accurate picture of the true cost of borrowing or the real return on investment compared to the state or nominal interest rate. In simple words, EIR shows the real rate because it considers how interest is added over time, not just the basic rate that is shown. In practice, EIR depends on how often interest is compounded, such as monthly or daily. The more frequent the compounding, the higher the effective interest rate will be. This is because interest is earned not only on the original amount, but also on the interest that has already been added. This is called the compounding effect. For example, if a bank offers a loan with a state rate of 12% per year compounded monthly, the actual cost of the loan will be higher than 12% because interest is calculated every month on the remaining balance, including the previous interest. So, EIR is widely used in finance to compare loans and investment products more accurately. It helps borrower and investor make better financial decisions instead of just looking at the nominal interest rate. Besides that, EIR also helps to provide transparency in financial transactions because it shows the actual rate involved after considering all effects of compounding. This allows individuals to have a clearer understanding of the real amount they need to pay for a loan or the actual return they can receive from an investment. Therefore, understanding EIR is important because it helps people evaluate financial products more effectively and choose the option that best suits their financial needs.
Lastly, I will present the comparison between effective interest rate (EIR) and effective profit rate (EPR). So, effective interest rate or EIR is used in conventional finance It measures the actual interest earned or paid after taking compounding into account. In contrast, effective profit rate or EPR is used in Islamic finance to measure the actual profit earned or charged through Sharia-compliant financial transaction. There are several key differences between EIR and EPR. First, EIR is based on interest, also known as riba, while EPR is based on profit generated through permissible business and financing activities. Second, conventional finance allow interest-based transaction, whereas Islamic finance prohibit riba and require all transactions to comply with Sharia principle. Third, EIR is commonly used in conventional products such as loans, bonds, and saving account. On the other hand, EPR is applied in Islamic financial products such as murabaha, ijarah, musyarakah, and sukuk. In terms of risk, conventional finance generally places most of the risk on the borrower, while Islamic finance promotes risk sharing between the parties involved. In conclusion, both EIR and EPR measure the actual cost or return of a financial transaction. However, EIR is interest-based and used in conventional finance, while EPR is profit-based and aligned with the principle of Islamic finance.
In conclusion, the comparison between effective interest rate, EIR, and effective profit rate, EPR, clearly shows the difference between conventional and Islamic finance system. EIR is based on interest rate charged on loans, which is related to riba and is prohibited in Islam, as stated in the Quran. In contrast, EPR is based on profit generated from Sharia-compliant contracts that involve real economic activity and mutual agreement between parties. Therefore, EPR provides an Islamic compliant alternative to EIR, ensuring that financial transactions are more ethical, transparent, and aligned with the principles of fairness and justice in Islam.